All right, let's dive right in. Today, we're talking about the world of Forex trading. It's this huge market that pulls people in with promises of flexibility and financial freedom. But, and this is a big but, there's a serious catch that most beginners just don't see coming. We're going to break down exactly what that is, and more importantly, how you can build a solid foundation to actually succeed. Okay, let's just start with this number, because it's a big one. Over 80%. That's how many new Forex traders lose money. Many of them just give up entirely before they ever see a single dime of profit. Now that's a staggering figure, but I want to be really clear. It's not because trading is some kind of scam, it's because of a series of really common and totally avoidable mistakes. So the big question is, what's really going on here? Why are 4 out of every 5 new traders failing? Well, the good news is, this isn't some big mystery. The reasons are actually really well understood. And by the time we're done here, you'll know exactly what those pitfalls are, and way more importantly, how you can sidestep them completely. So, here's our game plan. First, we'll dig into that 80% problem. Then, we'll build a solid foundation by really understanding the market itself. After that, we'll talk about shifting your mindset from gambling to strategy, mastering risk and reward, and finally, we'll wrap it all up with a pre-trade checklist you can start using right away. Sound good? Let's get into it. That crazy high failure rate, it doesn't come from some big, complicated secret. Honestly, it just boils down to a set of mistakes that almost every single beginner makes, over and over again. We can actually group all of these mistakes into 3 main categories. And just understanding what they are is the very first step to making sure you don't fall into the same traps. And here they are, the big 3. First up, you've got mindset mistakes, thinking you're going to get rich overnight. Second, there are strategy and planning mistakes, which basically means you're just clicking buttons randomly without a real plan. And third, and this one is maybe the most destructive of them all, are mistakes in risk management and how you use or misuse leverage. We're going to tackle every single one of these. Okay, but before we can even think about fixing mistakes, we need a basic lay of the land, right? I mean, you wouldn't try to navigate a new city without a map, and you definitely shouldn't try to trade a market without understanding its core pieces. So let's do a quick run-through of what we're trading, when we can trade, and the main thing that actually makes prices move. So at the very heart of Forex is this thing called the currency pair. You're never just buying a currency in a vacuum. You're always trading the value of one currency against another. Let's take EURUSD. The first one, the euro, is the base. The price you see is just telling you how many US dollars. That's the quote currency. It costs to buy 1 single euro. So if you buy the pair, you're betting the euro gets stronger. If you sell, you're betting the dollar does. It's like a constant tug of war between 2 entire economies. Now, these are what we call the 7 major pairs. They're the most traded in the entire world. And you probably noticed the pattern, right? They all involve the US dollar. For anyone just starting out, these are a fantastic place to begin. Why? Because so many people are trading them, they have super high liquidity. All that means is it's really easy to get in and out of trades, which usually leads to more stable conditions and cheaper trading costs for you. Here's something really cool about Forex. Unlike a stock market that opens and closes, the Forex market, it basically never sleeps during the week. It runs 24 hours a day across 4 major financial centers around the globe. So as one market is closing down, another one is just waking up. It creates this continuous, rolling cycle of activity that gets passed like a baton from Sydney to Tokyo, over to London, and then finally to New York. But check this out. Timing is everything. Look at that massive spike in activity on the chart. That's the sweet spot, the overlap when both the London and the New York markets are open at the same time. This 4-hour window is absolutely critical because it's when you typically see the most trading volume and the biggest price moves, which creates the best opportunities for a lot of short-term traders. Okay, so what's the one thing, the single biggest driver that moves a currency's value over the long term? It really boils down to this: interest rates. See, when a country's central bank decides to raise its interest rates, it makes that currency more attractive to foreign investors. That increases demand, and boom, the value of the currency goes up. And of course, cutting rates can do the exact opposite. This is a fundamental concept you've just got to understand. All right, now we're getting to that first major pitfall, mindset. This is where so many beginners go completely off the rails. They come to the market with this lottery ticket mentality, just hoping to strike it rich. The most critical shift you have to make is to stop thinking like a gambler and start acting like a disciplined business owner. And I mean, the difference between these two approaches couldn't be more clear. A gambler runs on gut feelings, emotions, and chasing that one big win. A professional trader, on the other hand, follows a disciplined process. They take calculated risks, and they focus on getting better at a skill over time. Making this mindset shift, it's completely non-negotiable if you want to have any long-term success. And that brings us to such a crucial point. You have to understand that profit isn't the goal, it's the result. It's the byproduct. When you focus on executing a solid, well-defined process over and over again, the money it takes care of itself. The second you start chasing profits directly, you start making emotional decisions, and ironically, that's what leads to losses. So how do you actually force yourself to have that business mindset? Simple. You create a written trading plan. It doesn't need to be some 100-page document, it just needs to clearly spell out your rules. What exactly has to happen on the chart for you to enter a trade? Where are you putting your stop loss to cap your loss? Where are you going to take your profits? And what is the absolute maximum you'll risk on one trade? Writing this stuff down is your greatest defense against making stupid, emotional decisions in the heat of the moment. Okay, listen up, because this is important. Even if you have the perfect mindset and the world's best strategy, you can still fail. How? Because a great offense is totally worthless if you don't have a strong defense. In trading, your defense is risk management, and it is the one thing that separates the traders who survive from the ones who inevitably blow up their accounts. And your number one defensive tool, your best friend in trading, is the stop-loss order. Seriously, just think of it as your safety net. Before you even click the buy or sell button, you decide the absolute maximum you are willing to lose on that trade. Then you place an order that automatically closes your position if the price hits that level. It takes all the emotion out of cutting a losing trade. You have to use it. Now we have to talk about leverage. Leverage is this tool brokers give you that lets you control a huge amount of currency with just a little bit of your own money. And yeah, it can magnify your profits, which sounds great, but it's a massive double-edged sword. It magnifies your losses just as easily, and I'm telling you, misusing leverage is the single fastest way a beginner can completely wipe out their trading account. You have to treat it with extreme respect. So, how do the pros handle this risk? Well, they live and die by a simple, strict rule. The professional standard is to risk no more than 1% of your total account on any single trade. So if you have a $10,000 account, that means no single loss can be more than $100, period. This one rule keeps you in the game long enough to let your winning strategy actually play out. Okay, we've covered a lot. We've talked mindset, strategy, and risk management. Now, let's pull all of those pieces together into a simple, repeatable checklist that you can use to stay disciplined before every single trade you take. This 5-step routine right here, this is your path to becoming consistent. 1. Always review your written plan. Never ever trade on a whim. 2. Check the economic calendar. Is there some big news announcement that could throw the market for a loop? 3. And this is the hardest part for most people, be patient. Wait for your specific setup to appear. Don't chase the market. 4. When it's time to execute, use that 1% risk rule to calculate your position size and set your stop loss right away. And finally, number 5, keep a journal. Log your trades, what you were thinking, how you felt. It's how you'll learn from your wins and your losses. And really, that's the main thing I want you to take away from all of this. Success in Forex trading, it doesn't come from luck. It doesn't come from finding some secret indicator or a shortcut. It comes from treating it like any other serious skill or profession. One that takes knowledge, a solid plan, and most of all, the discipline to follow that plan day in and day out. So I'll just leave you with this one question. After seeing exactly why 80% of traders fail, you really have a choice to make. You can join them by continuing to look for that magic bullet, that shortcut. Or you can commit, right now, to building a disciplined process. The choice you make is going to determine which one of those groups you end up in.